All right, let's get right into it. Today, we're breaking down a really interesting report that gives us a 15-year look into the future of Tata Technologies. We're going to explore its potential, crunch the numbers, and figure out what it all could mean if you're in it for the long haul.
So, every journey has a starting point, right? For this analysis, our starting line is right here, a stock price of 653 rupees. Keep that number in your head, because everything we're about to talk about, all the projections, all the possibilities, it all builds from this single price point.
Which, of course, brings us to the big question, the one everyone wants an answer to. 15 years from now, where could this stock actually be? It's a huge time frame, I know, but this report actually uses a pretty structured way to come up with some potential answers.
But look, before we get ahead of ourselves and start gazing into a crystal ball, we have to understand what's happening right now. So first, let's get our feet on the ground and take a quick snapshot of the company's financial health today.
Okay, let's unpack these numbers because they tell a story. That price to earnings, or PE ratio, is sitting at 38.2. In simple terms, that means the market has really high hopes for growth. It's willing to pay a premium. Then you've got ROCE and ROE. Think of these as efficiency scores. And at nearly 26% and 20%, those are seriously strong numbers. It tells us the company is really good at turning the money it has into more money.
All right, so we've got the now down. Let's shift gears and look at the what's next. What are the big, powerful trends that could act like rocket fuel for this company over the next decade and a half?
The report points to 5 huge tailwinds. First, more and more companies are outsourcing their complex engineering and R&D. That's a massive market. Second, well, it's impossible to ignore the EV and self-driving car revolution. Third, you've got this digital makeover of factories, what people call Industry 4.0. Think robots, data, automation, the whole shebang. Fourth is this global China plus one strategy, where companies are actively trying not to have all their eggs in one basket. And finally, you can't forget the incredible advantage of just being part of the massive Tata Group. That's a unique power-up.
Okay, so we've got these big picture ideas, but what does that actually mean for the stock price? This is where the report gets down to brass tacks. It doesn't just give one prediction. Instead, it models 3 different scenarios for how the future might play out.
Now, these are the fundamental assumptions, the very foundation of the projections. The analysts are penciling in revenue growth between 10 to 16% a year. But here's the really crucial part. Look at the exit PE. That's what they think the market will be willing to pay for the company's earnings 15 years from now. Notice how that range, 22 to 30, is actually more conservative than today's PE of 38. That's a big deal. It means this analysis isn't just assuming the hype goes on forever. It's building in a dose of reality.
And here's what you get when you plug in all those assumptions. In the conservative case, the stock could end up somewhere in the 1,650 to 1,800 range. The base case, kind of the most likely scenario, is aiming for about $2,750 to $3,000. And then there's the bull case. If everything goes right, if all those tailwinds are blowing at full force, we could be looking at a price tag between $5,000 and $5,400.
But let's be honest, what really matters is what that means for your returns each year, right? That's what this CAGR number shows us. Think of it as your average annual scorecard. In the conservative world, you're looking at about 6.6% a year. The base case bumps that up to a very solid 10.1%. And in that really optimistic bull case, you're talking about a potential annual return of almost 15%. That really puts things into perspective.
Okay, those numbers look pretty exciting, no doubt. But, and you knew there was a but coming, in investing, it's never all sunshine and rainbows. Every story has a flip side.
So we absolutely have to talk about that flip side. What could go wrong here? To get the full picture, we've got to be clear-eyed about the potential headwinds and the real risks involved.
The report really hammers home 3 main concerns. First, that high valuation we mentioned. The stock is already priced for a lot of success, so if growth stumbles even a little, it could get hit hard. Second, being so tied to the auto sector is a double-edged sword. If that whole industry hits a rough patch, Tata Tech feels it directly. And third, you have to remember that big tech and engineering projects are cyclical. When the global economy gets nervous, those are often the first budgets to get slashed.
All right, so we've weighed the massive opportunities against some pretty significant risks. After all of that, where do we land? What's the final verdict from this deep dive analysis? Let's tie it all together. The report's conclusion is crystal clear. It says, Tata Technologies is suitable as a long-term compounder for patient investors, best accumulated during market corrections and held as a core portfolio position.
For me, the two absolute key phrases there are long-term compounder and patient investors. This is not a get-rich-quick story.
And that really leads us to one last big question, a question for you to think about. The entire analysis hinges on this idea of patience. But in today's world, where the market moves at the speed of light, what does being a patient investor really truly mean? That's something worth considering. Thanks for joining me today.